important discussion to you. I encourage you to all to actively participate, ask as many as questions, share your thoughts, and make the most of this opportunity to gain a deeper understanding of how these changes will affect your businesses and your personal finances. Once again, welcome to all of you, and I look forward to a productive session. Over to you, Deepak ji.
Thank you, Akshat ji, for this introduction. So let me share the presentation that I will be using today. So let me know if my screen is visible. Akshat, is it visible?
Yes,
Yes,
it's
it's
a
visible.
perfectly visible.
Yeah, okay. Uh, so in this session, we will be dividing this into two parts, where in the first session, we will be discussing the amendments that was brought in under the direct taxes that I will be discussing. And the second part of indirect taxes will be discussed by Mr. Ankur Gupta. So if I talk about this budget, so in my opinion, this is a very good budget, but I think the best is yet to come. Considering that the new finance bill, I'm expecting that the new finance bill will be more simpler and should serve the purpose of ease of doing business in India. And if I talk about the MSME sector, I think it is the core of our country and it is a major contributor to the GDP. Now, coming to this budget, the changes that were introduced in this budget, while there are not too many changes, but there are few changes which are very important and the critical ones that I would be discussing. So, first one is related to the individual taxation that I would be discussing. Second one is related to the changes in TDS provisions. Then TCS provisions are there, litigation provisions, transfer pricing provisions, and there are some other key amendments that I will be discussing in this session. So first, start with the personal taxation. So our Honorable Finance Minister this time has listened to the middle class taxpayers well. So they have changed the slab rates under the new regime of taxation, and practically there is no tax on the total income of up to rupees 12 lakhs when we consider the rebate. So if a person is earning income up to rupees 12 lakhs, then practically they don't have to pay any taxes. Now, if I come to the salaried taxpayers, that benefit of rupees 12 lakhs, it gets increased to 12 lakh 75,000, considering that they have raised the limit for standard deduction from rupees 50,000 to 75,000. So practically it will be 12 lakh 75,000. And the rebate has been increased from 25,000 to 60,000. So like I mentioned that they have made changes to the slab rates which is applicable for the new regime of taxation. Because of this new regime of taxation, slab rates has been changed. Reduction of tax is also there, and if I add the benefit of rebate under section 87A, you will be getting a rebate of rupees 60,000, which was earlier capped at rupees 25,000. So I expect that this will bring a smile to the middle class taxpayers, and I'm expecting that there will be increased demand for the consumers industry, for the electronics industry, and for other sectors as well. So there is one more amendment that was brought into this budget, which is related to the house property. So earlier there was a situation where a person used to claim nil annual value for their first self-occupied property. But if that person had a second self-occupied property and for some reasons that self-occupied property, or that property is not being rent, and it is being used for their own use, then there were two conditions that if you are using it sorry, if you're not able to use it because of your business or your employment, then you can claim that the annual value of that second house property is nil. But now, because of this amendment, what they have done that this requirement of employment, business, or profession is no longer there. So today, if you have two self occupied house property, and you're not earning any rent, you can claim the value to be nil. So does this mean that if there is a loan for property one, and also there is a loan for property two, and you are paying interest on home loan for each of the properties, does this mean that you will be getting the deduction of rupees 2 lakh for each of the house property, or both the house properties? So I think this is capped to rupees 2 lakhs only. You will be getting only 2 lakhs as the deduction. But let's see what rules will be prescribed, if there are any. Now I'll move to the amendment related to the TDS changes. Uh, so it's been a long time since the threshold limit for the TDS sections was revised. It was same, and it was being continued for a while now. So in this budget, there are some changes which the finance minister has proposed, that they have proposed to increase the current threshold for most of the sections. But here we will be discussing the major sections which are relevant for the industry. So, for example, if I talk about section 193, where TDS is deducted on interest on securities. Previously, there was no threshold prescribed. Even if you are paying 100 rupees, you will have to deduct TDS. Now there is a threshold of rupees 10,000. When we come to section 194A, for senior citizens, if the payer is bank or the cooperative society or post office, earlier the limit was rupees 50,000, which is now proposed to be increased to rupees 1 lakh. But if you are not a senior citizen, earlier the limit was 40,000, now it is increased to 50,000. And in all other cases, if you're a company, you're a firm, you're an LLP, or any other organization which is paying interest, so the limit has been increased from rupees 5,000 to 10,000. Now coming to the dividend part, earlier if you're paying dividend for more than rupees 5,000, you had to deduct TDS. Now the limit has been increased to rupees 10,000. There is no TDS up to rupees 10,000. The next one is the commission or brokerage under section 194H. So around, I mean, 5 to 6 years back, the limit was used to be 5,000, which was increased to 15,000. Now it has been increased to 20,000. So if you are paying brokerage or commission, which is not exceeding rupees 20,000, you don't have to deduct any TDS. Now coming to the rent part, this is a very interesting amendment where earlier you need to see the threshold on a yearly basis. Now you need to see the threshold on a monthly basis. So if you are paying rent of up to rupees 50,000 on a monthly basis, you practically do not need to deduct any TDS. So uh, if I analyze this figure, this will come to rupees 6 lakhs. So for an amount up to rupees 6 lakhs on an annual basis, you don't need to deduct TDS. Now coming to section 194J, limit has been increased from 30,000 to 50,000. And for the compensation part, if you are getting any compensation for the compulsory acquisition of property, so it has been increased from rupees 2,50,000 to 5 lakhs now. Now coming to the TCS provisions, there have been a few amendments in the TCS provisions as well. First one is the enhancement of threshold under the liberalized remittance scheme, where no TCS is required to be collected up to rupees 10 lakhs. Earlier, this limit was rupees 7 lakhs. And also, there is one more amendment with this LRS scheme, that no TCS is required to be collected where the remittance is made for the purpose of education loan. And this education loan has for the purpose of education, and the remittance is being made out of a loan taken from a specified financial institution. So suppose if you are remitting a certain amount which is for the purpose of education, and it has been taken through a loan from a financial institution, then practically you don't need to collect any TCS. And the second amendment, this is very crucial for the industry, because people were finding it very difficult to manage their TCS compliances as well as the TDS compliances. Because earlier, both TDS as well as TCS were applicable on the sale or purchase of goods. Uh, the sellers were not able to make sure that the person who is buying the goods, whether they will be whether they will be deducting TDS or not, whether they should collect TDS at the first instance. So now, more considering these practical difficulties being faced by the industry, it has been proposed that only Section 194Q will continue, and 206C1H has been deleted. So the other amendment, it is in line with the TDS amendment that was brought in last year, where no prosecution to be initiated where the TCS has been deposited before filing the quarterly TCS return. Now, if we're coming to the last amendment related to the TCS, or I would say it is for the TDS also. Department has proposed to remove section 206 AB and 206 CCA. 206 AB provides for deduction of TDS at a higher rate, and 206 CCA provides for collection of TCS at a higher rate. In those cases where the deductee or the collectee has not filed their income tax return, but it was very difficult to identify if the deductee or the collectee has really filed their returns or not. So it was a compliance burden, and it was resulting into tedious demands for the taxpayers also, because you need to check on the date of deduction, not on the date of return filing. So it was very difficult for that reason. Both the section 206 AB, 206 CCA, they have been deleted now. Now coming to the next part, where we will be discussing about the key changes in litigation. So I've divided this section into two parts. First being the amendments related to search and block assessment, and the other being the other amendments. So starting with the first, if I talk about search and block assessment, so the post search assessment, there is a concept of block assessment. So the post search assessment can be made for the period which may not be pending, even if the assessment for that period is not pending, but the assessment is required to be made, or it is yet to be made, then that assessment is also covered under the block assessment. So it will basically enhance the scope of block assessment part. The second amendment being the competition mechanism under the block assessment has undergone few changes, which is in itself is a topic for the separate discussion, and it's a quite lengthy one and cannot be covered in this session. So we will try to cover it in a different session, maybe in next session when we have the full-fledged budget. Now the third amendment. So the order under the block assessment can now be passed within 12 months from the end of the quarter in which the last authorization was made. Earlier, this time limit was 1 month only. Now, if I talk about the other amendments. So now the time limit to pass the penalty order pursuant to order of CIT appeals and ITIT appeals has been aligned to 6 months from the end of the quarter in which the connected proceedings are completed, or the order of appeal is received, or the revision order is passed. Because earlier there were multiple timelines. For CIT appeal, they had different timelines. For the ITAT appeals, they had different timelines. The post completion of these proceedings, it was very cumbersome for the taxpayers to identify which timelines to follow. So now they have simplified, and they have made it consistent for all the appellate proceedings. Fifth one being the faceless scheme that was proposed to be introduced for the transfer pricing and the and various other proceedings which are not yet notified. So earlier they were required to be notified by 31st of March 2025, but now they have just removed the timeline so they can prescribe these proceedings, prescribe these faceless scheme in any given point of time. Now coming to the transfer pricing provisions, there is a very important amendment. It has been proposed that the transfer pricing provisions are to be rationalized to provide tax certainty, just like we have the option of APA, Advanced Pricing Agreement, Safe Harbor. So they are proposing that in line with the Advanced Pricing Agreement, they have proposed that the arm's length price that the transfer pricing has determined, it shall be applicable for 2 consecutive years, apart from the year in which the transfer pricing assessment has been made and the arm's length price has been determined. That price will be applicable for 2 more years if the transaction is of a similar nature. So there is a set of procedure that is prescribed here, where the taxpayer will exercise this option in a form which will be prescribed, and the TPO will see that if they want to accept or reject this request of the assessor. So in my opinion, this should reduce the litigation burden for both the taxpayer as well as the department, considering there will be less litigation in each of the year. Because in most of the cases we see that international transactions are repeating on a year basis, where there is no changes in the other conditions. Mostly the arm's length price is the same that the assessor determined. Mostly the transfer pricing officer also makes the same adjustments. So there was no reason to keep it on a year-on-year basis. So that is the reason they are proposing to keep it for 3 years if the taxpayer is agreeing to the transfer price, agreeing to the arm's length price of the international transaction. Now I'll come to my last slide related to the direct tax amendments. There are few other amendments which are very important, and they're worth mentioning. So first one is the extension of time limit to file the updated return. Earlier, this time limit was 2 years. You could file your updated return for 2 years, which is now extended to 4 years. So you can file your updated return for the 4 consecutive previous years. Just one condition, that you need to pay the additional tax depending on the period of delay. So if there is a delay of 12 months, then you need to pay 25% as additional tax. If it is 24 months, then 50% is the additional tax. If it is 36 months, 60%. If it is 48 months, then you will be paying 70% as the additional tax. Second amendment is related to the startups. So with the motive of promoting the investments in India and promote the new businesses, it is now proposed that an eligible startup can be incorporated before 1st of April 2013 now. If when I talk about eligible startup, why this term is relevant? Because under section 80 IAC, if you are an eligible startup, so for being eligible, there is a condition that your turnover is below 100 crores, and you have been provided with a certificate of eligible business from the Interministerial Board of Certification. And you have commenced your operations, you have incorporated your entity before 31st of March 2025. So now this condition of incorporating an entity has been extended to 31st of March 2030. So you have to incorporate the entity before 31st of March 2030 so as to be eligible for claiming the benefit. So what is the benefit? The benefit is that you can claim deduction of 100% of your profits for a consecutive period of 3 years. So there is a concept of block of 10 years. Right after the incorporation, under the block of 10 years, you can claim deduction for any 3 years. So this is something which is going to be crucial for the investments in India, for the new investments, and for the new companies that want to incorporate in India and want to start a new business, or they have some new idea. So last one is the rationalization of provisions related to carry forward losses in case of amalgamation. So the provisions related to carry forward of losses in case of amalgamation has been rationalized, where the 8 years for the purpose of computing the carry forward of losses of the amalgamating entity will now be computed from the year in which it was actually incurred. So this section says that the losses of the amalgamating entity will be the losses of the amalgamated entity of the year in which the amalgamation has taken place. So practically, if the losses of amalgamating were expiring in the 6th year or the 7th year, and just after 1 year, the amalgamation has taken place. So even if you're not eligible, you could have carry forward it for another 8 years, but now they have made it consistent. You can carry forward it for the period of 8 years only, starting from the year in which it was actually incurred. So this was from the direct text part. Now I will request Ankur Gupta sir to take up the indirect text amendments.
Thanks, Deepak. Welcome, everybody. And thanks, Akshat, for organizing this. In terms of indirect tax, we have seen in the past few years that eventually the purpose of incorporating GST-related changes is primarily to incorporate what the GST Council meetings over the period have suggested, and to give it a formal shape in terms of making it part of the finance bill. So catering to that, the first amendment that has been brought under GST is pertaining to amendment in the provisions of ISD. So this provisions relating to ISD underwent major amendments through the Finance Act 24, which is to be implemented from April 1st, 2025. One of the key changes was that ISD can distribute ITC of GST paid under RCM by a distinct person in terms of Section 9, subsection 3 and Section 9, subsection 4 of CGST, which primarily means only intra-state supplies. Now, this amendment that has been brought in will also cover interstate supplies. So this is a interpretational dispute which has been duly addressed by the Finance Ministry, and this will ease off the compliances. Second is with respect to amendment in Schedule 3, which is exemption for supply in SEZ warehouse. So Schedule 3 of CGST Act prescribes the list of activities or transactions which would neither be treated as a goods nor as a services. So there is a clause AA, which is proposed to be inserted in paragraph 8 of Schedule 3 retrospectively with effect from 1st July 2017 to include supply of goods warehoused in a special economic zone or a free trade warehousing zone to any person before clearance of such goods for exports or to domestic tariff area, or we call DTA. The applicability of GST on transfer of title of goods stored in FTWZ or SEZs before clearance has been a vexed issue, as the said goods cannot be treated as a warehoused goods technically, since SEZ and FTWZs are not specifically covered in the definition of the term warehouse under Section 2, subsection 43 of the Customs Act. Now, prior to this proposed retrospective amendment, there was a AAAR of Tamil Nadu in case of Panasonic Life, and AAR of Telangana in case of AIE Fiber Resources, which have held that such transactions are not liable to GST. So therefore, by virtue of this proposed retrospective amendment, the supply of goods within SEZ and FTWZ will now be treated at par with the supply of warehouse goods before clearance for export or home consumption. The third point is pertaining to there's a proviso that has been added in Section 34, which is for issuance of credit note. Now, this is a most talked about changes under GST, which most of the industry is talking about because the liability is eventually being casted on the suppliers. So, what the proposal is that a proviso will be added to cast an obligation upon the supplier regarding reversal of corresponding ITC if availed by the registered recipient for the purpose of reduction of tax liability of the supplier in respect of said credit note. Now, this was already covered in 55th GST Council meeting, and it introduces a precondition that the reduction in outward tax liability of the supplier will only be permitted if the registered recipient has reversed the corresponding ITC. So this places an additional burden on suppliers, as they must ensure that the recipient has reversed the ITC in IMS before they can claim the benefit of reduced outward tax liability. What is to be seen is that there still exists a possibility that this amendment will be contested on the premise that the suppliers will have to bear the consequences of recipients' non-compliance, despite having no control over recipients' actions. Accordingly, it needs to be seen if the said amendment faces any challenges before writ court. Only the time will tell. The next amendment is pertaining to changes in Section 107 and 112, which are primarily appeal to First Appellate Authority and to Tribunal. So a proviso has been added to Section 107(6) and 112 subsection 8. And though that proviso is to be amended, which prescribes a requirement for a pre-deposit for filing of appeals before the appellate authority in respect of cases where the matter involves only demand of penalty without involving any demand of tax. And the pre-deposit here will be 10% of the penalty amount. Now, let me take you back to Finance Act 2021, wherein this proviso was actually added in Section 107 and 112, which stipulated that no appeal could be filed before the appellate authority against an order issued unless pre-deposit of 25% of penalty amount was paid. Now, Section 129 pertains to detention, seizure, and release of goods and conveyance which are in transit. So consequently, the pre-deposit requirement for cases involving only demand of penalty was limited to situation arising on account of seizure or detention of goods. However, with this proposed amendment, the pre-deposit requirement would be applicable in all cases of appeal against the orders involving demand of penalty without any demand of tax. So the scope has been increased beyond the Caesar or Section 129. Because as of now, if I want to contest a order only in terms of penalty amount, there is no requirement to do a pre-deposit. But going forward, I will need to make a pre-deposit for filing an appeal, which doesn't involve any tax amount, but only the penalty amount. The next amendment is pertaining to omission of section 12.4 and 13.4, which stipulates the time of supply of voucher. So there was a Karnataka High Court decision in last year or a couple of years back in case of premier sales, which held that vouchers do not fall under the category of goods or services and therefore cannot be subject to GST. Now, this proposed amendment is in line with that decision, and the recent circular, which was issued in December 24, both holding that non-applicability of tax on vouchers, and therefore there is no need for determination of time of supply. Uh, Next slide, Deepak. Now, this amendment of section 17.5D is primarily to overturn the decision of Safari Retreats. So what it proposes, section 17.5D has been proposed to be amended retrospectively from July 1, 2017, wherein the phrase plant or machinery is being replaced with plant and machinery. Accordingly, the definition of plant and machinery as provided under explanation to section 17 will also be applicable to section 17.5D. Now, this amendment is based on the recommendation of 55th General GST Council meeting. The proposed amendment restricts the eligibility of ITC of goods and services used for construction of immovable property on one's own account, such as building or warehouses or any other civil structure. So the said amendment has a significant impact on the infrastructure projects and commercial leasing activities. So there was a Supreme Court's landmark judgment in case of Safari Retreats case, which had differentiated and distinguished the two phrases plant and machinery and plant or machinery, and held that a building can also be considered to be a plant depending on the functionality test. The possibility of SSC challenging the retrospective amendment cannot be ruled out because the past decisions of Honorable Supreme Court affirming the principle that vested rights accrued in favor of an SSC cannot be retrospectively revoked through an amendment. And above all, with the kind of amendment this proposes, so this clearly is denying the benefit to the SSC at large and is never received well by the industry. It seems to be a regressive step, and it's against the spirit of stability and predictability, which might woo away the investors. Next is Deepak, next slide. A new concept of track and trace mechanism has been introduced. So new section 148A has been proposed to be inserted for implementation of track and trace mechanism for ensuring effective monitoring of specified goods. These specified goods will be notified later, or the persons or class of persons, so whatever will be the criteria would be notified later. And the primary intent or what it would require is such specified goods will have to bear a specific unique identification marking, including the information that would be notified, the details in respect of such goods, including manufacturing, machinery used for manufacture, location of factory. So each and every detail pertaining to those goods would be captured in this unique identification marking. The background to for such an amendment is that a group of ministers had recommended implementing track and trace mechanism in line with internationally accepted practices to curb illicit trade, detect revenue leakages, or curtail tax evasion. There have been in past there have been numerous instances of tax evasion detected by CBIC officials associated with tobacco industry. So, in order to combat such evasions, this track and trace mechanism has been proposed to be implemented. Next slide, Deepak. Now, this moving on to customs and central excise amendments. So, the first and foremost change that has been brought in the legislation is pertaining to settlement commission. So the settlement commission is proposed to be terminated, and interim board will take place of settlement commission. This would be the effective date of this would be April 1st, 2025. What it means for a SSE or a business is it signals the end of the entire settlement commission or the settlement scheme under both Central Excise and Customs Act, and is in conformity with the intent of the government to expeditiously close pending settlement applications. To this effect, I think in Union Budget 23-24, a timeline of 9 months, extendable by 3 months, was prescribed as for settlement commission to dispose of all the pending cases. However, the settlement commission failed to do so, and it appears that government has decided to constitute the interim board and transfer all the pending cases to this board. Another significant departure is the constitution of interim board. While the settlement commission could have non-revenue members having exceptional knowledge of the subject, the interim board will be solely constituted of senior revenue officers only. Given the pendency and intricacies of the matters which are usually before the settlement commission, it will have to be seen whether the interim board is able to live up to the expectations of the government as far as the expeditious disposal of the cases is concerned. Deepak, next slide. Then there has been an introduction of time limit for finalization of provisional assessments under customs. So sections 18 has been proposed to be amended to provide a definitive time limit of 2 years for finalization of provisional assessment. This time limit is extendable to a further period of 1 year. However, such extension can be done on sufficient costs, which officers can seek a permission from the commissioners. This amendment is a significant step in ensuring that there are defined timelines for finalization of provisional assessments, addressing the long-standing issue of undue delays in the process. Provisional assessment, particularly in cases involving import with exemptions, valuation disputes, import under FTAs with concessional duty benefits, those have been often delayed and have been extended, sometimes even for decades. So this results in significant burden on importers who are required to furnish bank guarantees or bonds for prolonged period, and also an uncertainty about the fate of final assessment, which has a direct bearing on the duty and interest payment. Additionally, this time limit of 6 years has already been challenged in the case of Bihar Foundry, wherein the Jharkhand High Court had held that the CBSE manual provided, which was issued in 2015, had provided that time limit of 6 months for the closure of the provisional bill of finalization of provisional bill of entry. However, in Bihar Foundry, the Jharkhand High Court held that if the case has not been closed within 6 months, then it was time barred. And to overcome that Bihar Foundry decision, it seems that the time limit has now been actually prescribed, that the assessment has to be completed within the time limit of that 2 years. Now, also good amendment has been, or introduction of mechanism for voluntary revision of bill of entry post clearance of goods. So this is a welcome move by the industry, and it actually will enhance the voluntary compliance and minimize the litigation risk, because it will allow the importers and exporters to self-correct the errors, if any, made at the time of filing bill of entry, even after clearance of goods. Earlier, these rectifications required either filing of an appeal or seeking specific amendments, often leading to disputes with the department and acceptability at the department level as well. Now, with this change, all the importers can proactively revise their entries, provided no notices or audits or any scrutiny is undergoing, to avoid misuse of this provision. I think these are the changes that have been brought in. Apart from this, a lot of changes have been done under the tariff part, but due to paucity of time, have not covered that. Uh, Over to you, Akshat, if we have any questions, or we can start off with that session
Sir,
moderator
question
session.
we can take at the end of the session, and
Mhm.
we start with the panel discussion. And
Yeah.
I would request to all our panelists, please switch on their video. Thank you very much. As I already introduced our panelists, once again, I'll just repeat it. We have a panel discussion on decoding the union budget, and our session moderator is Mr. Deepak Avasthi, and our panelist includes Ankur Gupta sir, Grish Gogia sir, and Bhupender Pal sir, and they all are well versed in his subject and the policy matters, and they will give you the better understanding about the budget. Now over to you, Deepak ji. Please continue.
Thank you, Akshay. So my first question is to Girish Gogia sir. Uh, so the threshold for the deduction of TDS under Section 194I has been increased from rupees 2,40,000 per year to rupees 50,000 per month when it comes to rent payments. So now you need to look at your monthly rental payouts. So how do you think this will impact the industries? Will it ease the compliance burden, or it has opened doors for increased compliances?
Uh, First of all, thank you very much, Mr. Akshat and Mr. Deepak, for inviting me as a panelist. I think this time during her budget speech, the FM has clearly mentioned that the TDS and TCS provisions have been rationalized, and the limits for all the sections have been increased. Most of the sections have been increased in line with the rationalization and ease of doing business. So one has to see this TDS under one section, under section 194I increase as a welcome step. But at the same time, you have to see it as a monthly compliance instead of annual compliance, because now you have to see each month if you are making the payment of rent to other person in excess of 50,000 rupee or not. So yeah, there is additional compliance, because you have to see it on a month on month basis. But at the same time, one person has got more rather what should I say the person has got more amount on which the TDS is not to be deducted.
So, continuing with the same question, I have another question. So, the threshold for various TDS sections has been increased. Do you think it will ease the compliance burden? And what is the larger benefit that the government wants to extend?
The government, the intent of this budget is to give the businesses breathing space in terms of compliances. So if you see all other sections also, like 194A, 194I, then 194B and 194H, in each section they have the government have extended the amount on which the tax is not to be deducted. So I think industry as a whole will welcome these changes, because this will reduce the compliances on the SSEs, on the deductors.
Right. So the next question is for Bhupender sir. So the department has proposed that the startup shall be deemed to be eligible to claim the benefit of deduction under section under 80 if it is incorporated before 1st of April 2030. Earlier, the due date was 1st of April 2025. So, Bhupender sir, what do you think about this extension? How is this going to impact the new investments in India? And what benefits do you foresee? Your comments, please.
Thank you, Deepak. So this is a very welcoming step from the government of India, and in this budget, this extension till 2030 will provide a lot of time for the new businesses to plan their taxes. So we see that the new startups may not start making money from the day one. So with a block of 10 years, they can at least plan their taxes better, and they will have a very advantageous position as far as tax breaks are concerned. So this will definitely encourage the long-term investments in the startups by the entrepreneurs as well as from the multinational companies. So this can possibly boost the ecosystem of the country and also invite some good foreign investments. We feel that overall this will help in doing the business at ease in the country and also attract some foreign exchange.
So talking about the investment and investment in India, there is one more amendment for the middle class taxpayers that the finance minister introduced. It was related to the this rupees 12 lakhs. Practically, you don't have to pay any tax if you are earning up to rupees 12 lakhs, 12 lakhs 75,000 if you are a salaried employer. So my question is to you, sir, that what do you how do you think this will impact the consumer industry in India? Do you think that there will be an increase in the retail consumption since they have more cash to spend? And apart from the consumption, which industries do you think will have an impact after such relief? Positive, negative? What are your thoughts, sir?
This is a big tax relief in the hands of the taxpayer, especially if they have income up to 12 lakh 75,000 per annum. So they will have some disposable income in their hand to spend. Of course, this spending will go up or the investments will happen. So if the spending will go up, the mostly I personally feel that the retail sector is going to get benefit out of it because people will spend money for improving lifestyle. So the disposable income will mostly be spent in the retail sector, but yes, few people would also like to invest. So we can also see there will be some changes in the investment pattern. So the income which is in the hand of the employee or salaried people will definitely be disposed of for investments. So beyond that, I see the people who are willing to buy the cars. So they will also have some money in their hands. So if they're falling short, so maybe the motorcycle using community will shift over to car with this quantum. So that's my take on it. And there will be broader economic impact on the inflationary pressure also, because if you have more income to spend, then possibly the demand and supply factor will also come into place. and we can see some inflation happening because of that.
Right, right. Thank you for the insight, sir. So this question is to Girish, sir, from the industry perspective. So, what do you think about the removal of Section 206 AB and 206 CA, which mandated that you need to deduct TCS or collect TCS at higher rate in cases where the deductee or the collectee is a non-filer of income tax return? How
Yeah,
do you see from the overall ease of compliance thing?
if you see, both these sections were mandated that the deductor or the collector need to check the status of the other person, whether he has filed his return of income or not. And this test is to be done right at the point of deduction, not at the time of filing of the TDS return. So practically, people were finding it difficult to comply with this at the time of deduction or collection. So either they were deducting more tax or less tax. So, similarly, they were finding it difficult. So practically, this question has been this suggestion has been given to the ministry, and ministry has taken it in the right direction by removing these two sections. And now the deductor or collector is not required to see the whether the SSE has filed the return or not. And so the industry is welcoming this step. I think most of the people is welcoming this budget, and especially these particular areas where the government has given some sort of release in terms of compliances.
Thank you for the insight, sir. Uh, so this question is for Bhupinder, sir. So, how do you think the extension of the time limit for filing the updated income tax return from 2 years to 4 years is going to benefit taxpayers and business in terms of compliance, ethical collection, and financial planning? What do you think, Bhupinder, sir?
Well, this is a welcoming step. I mean, increasing the limits from 2 years to 4 years is definitely welcomed by the industry. So this actually, to me, it reduces a lot of litigation because people get time to correct the returns from 2 years to 4 years, which is a very substantial period of time. And I think by the time by the time this amendment goes off and again come back to 2 years, people will learn how to file the income tax return and now understand how to get into the complexities of the income tax. So it is just making people aware. And the whole idea of this budget is not to put too much of burden on the taxpayers. It is just to make it a compliant situation where they feel that they are contributing towards the economy. So this is a very welcoming step. So correction from 2 to 4 years will definitely reduce the lot of burden of litigation with the assessees and with the department as well. So I think overall this is a very good step, and businesses are going to get a lot of relief and benefit out of it, especially the small businesses which don't have a capability to spend too much money on the compliances. And so this is a relief to them, like startups, SMEs. So they will definitely have a benefit out of it.
Right. At the initial phase, they often miss on filing the tax returns. So I think this is a welcome step.
Of course, it is for
Yeah.
everyone.
So the next question is for Ankur Gupta, sir. So this is related to ITC reversal, sir. The introduction of provision to ensure ITC is reversed by recipient for supplier claims deduction of liability. Do you feel compliance of suppliers is going to increase? Your thoughts, sir?
I have already highlighted during my session that definitely this is going to become a big pain point unless and until you are in a very organized supply chain structure wherein your vendors and your customers, each and everyone are too compliant and you have a control over them. But having said that, we are not living in an optimistic or a perfect world. So if I talk about from a legal perspective, then definitely the courts have consistently held that conditions imposing impractical or unfeasible compliance requirements and have held them to be arbitrary, unreasonable, and violative of fundamental rights. So there is a legal maxim which says lex non cogit ad impossibilia, which means the law cannot ask a person to do something impossible. Having putting a restriction on the supplier that they cannot make a reduction in their output tax liability unless and until the recipient has reversed the credit. While there is a system of IMS, there could be n number of scenarios. So, for example, if I've raised an credit note on say 31st of any month, and the vendor has received next month, he might not receive. He might see it, but he might not accept it under the MIS of that month. So that means I'll not be eligible to reduce my debt over liability unless and until he does it. So yes, there should be controls. There are certain controls which government needs to undertake, but the onus of this responsibility, that entire supply chain, now rests with the recipients and the suppliers.
Uh, Deepak ji, as we have short of time, so we will send all the queries to you over the email, and we need to wrap up this session here now.
No worries, just send those questions over email and I would be happy to answer them.
Sure, I'll send all the question by email to you and reply to the participant accordingly. And thank you very much all our experts to giving your valuable time and expertise with our participant. And definitely we have many more interaction in future as well. And thank you very much to SW for always support us for spreading the knowledge about the recent development in taxation, finance, assurance, and audit related topics. Thank you very much.
Thank you very much. Thank you, everyone.
Thank you, everyone. Thank you, Akshat.